Hello, everybody. Welcome. This is our last video in this series. Might make more in the future, but who knows? This is part 8, changing depreciation methods and changing estimates. This is by the accounting professor, which is myself, Bennett Tchaikovsky. This is copyright 2008 to 2022 by Bennett Tchaikovsky. All rights are reserved. Any redistribution is expressly prohibited without the prior written permission of the author. The opinions expressed herein are those of myself and not the author's employers and/or other affiliate organizations. So when we're talking about our last topic over here, changes in estimates, if we think about it, right, depreciation is, it lives based on estimates, right? Estimated useful life, salvage value, both of those are estimate. How many units are we going to be going through and producing, right? So because those are estimates, if we're wrong, it's okay. But what we're going to want to go through and do is we're going to record. If we do have a change in estimate, we're going to go through and record up until the date of change using the old information. Then we're going to go through and depreciate using the new information going forward. I inadvertently, in giving this last question over here, which basically this example over here is I inadvertently gave one of these types of questions. So what you want to do is you want to use the old information first, then you go through and use the new information going forward. Now, if you're changing depreciation methods, this is very different. This is going from straight line to double declining balance or to units of production. You use it using the old method up to a certain point, and then you use the new information for the new methodology. I am going to say something, though, which is like this is more of an accounting academic exercise, right? We as instructors, we do this because if you're doing a change in accounting principle, right? If you're changing and if it's materially significant, it's going to be a huge nightmare for you because the disclosure requirements when you change methods are going to not be good. And because they really, if you're changing methods, what happens is that your financial information, if you're showing multiple periods, no longer becomes comparable, which is one of the stalwarts of financial accounting. So again, if we change methods, or if you're changing estimates, you use the old method up into the date of change, then you use the one with, the new information. But I will say this, though, is that you're generally not going to go through and do this unless it's something really serious because the disclosure requirements are incredible. So here we have our two examples. So let's go through and take a look at these examples. So right over here, we purchased equipment for $240,000 on March 1st, 2028. The equipment was to last for 4 years and had no salvage value. Then on 1/1/30, it was determined that the equipment would last for 3 years from that date. Prepare the journal entry to record the depreciation expense for the year ended 12/31/30. Okay. So what we need to go through and do is we basically need to figure out how much depreciation have we gone through and have taken to date. Okay, so right over here. So my equipment, 240,000. Accumulated depreciation, right? So I'm making the change on 1/1/30. Okay. So on 1/1/30, now changing, I'm going to change this up. So I need to figure out what did I do during 2028? What did I do during 2029? Got to figure that out because this is going to give me my new depreciable base. So over here, if it was 240,000 and it was to last for 4 years with no salvage value, right? Acquisition cost minus salvage value divided by the estimated useful life. 240,000 minus 0 divided by 4. This is going to give me 60,000 per year. For 2028, though, I only used the asset for 10 months, March, April, May, June, July, August, September, October, November, December, 10 months. So over here, I'm going to take for 2028 depreciation expense. I'm going to go over here and say, okay, this is a full year of depreciation expense. I'm going to multiply this by 10/12. And this is going to give me 50,000. Okay, so over here for 2029, I'm going to take a full year. So on 1/1/30, when I'm going through and making the change here, well, what is the net book value of my asset? How much is remaining, right? Because right over here, well, I've got my net book value is going to be my equipment less the accumulated depreciation. My net book value over here is going to be 130,000. So it now tells me, though, that this from this point going forward, so this is going to be 12/31/29, right? So from this point going forward, it's going to be lasting for 3 years, right? So what I'm going to go ahead and do is I'm going to basically say, okay, my carrying value of my equipment minus my salvage value, my carrying value of the equipment up through the date of change is 130,000. My salvage value is still 0, and it's going to last me for 3 years. So over here, this is going to be 130,000 divided by 3, or 43,333. So the amount of depreciation expense I'm going to take for the full year ended 12/31/30 is going to be $43,333. If we think about it in terms of how this really works, right? So if I go through and take, right, 43, so in 2030, if I take the full year and it's going to last for 3 more years, the total amount of my accumulated depreciation at the end of the asset's life is going to be about 240,000. I can only take up to the salvage value because the salvage value is 0. I know that this answer is correct. So if I can come up with this answer, just kind of plug it in just to make sure it goes through and works. Okay, so that's an example where we have a change in useful life or a change in estimate. Okay, so over here, JFK on July 1st, 2027, purchased equipment for 120. The equipment was depreciated using double declining balance. The estimated useful life was for 4 years and had a salvage value of 20,000. On 1/1/29, JFK decided to switch to straight line for the rest of the asset's useful life. Prepare the journal entry to record depreciation expense for the year ended December 31st, 2029. Let's have some fun. Double declining balance, good review for us. Acquisition cost minus the accumulated depreciation divided by the estimated useful life times 2. If this is not familiar to you, please, please, please go back and take a look at the earlier video, right? So over here, we've got our 120,000 in 2027. We've got 120,000 minus 0 because this is the first year of doing it, divided by 4 times 2. This is going to give us 120,000 divided by 4 times 2, or 60,000. However, when I'm using, this is for a full year 1, double declining balance. However, I bought the equipment on July 1st, 2027. So what I need to do here is I need to take 60,000 July, August, September, October, November, December. I used it for 6 months. So from 7/1 through 12/31, this is going to be 6/12. 60,000 times 6/12 is $30,000. When I'm using double declining balance, I have to go through and use my formula, my chart, because I always have to worry about over depreciating an asset. So I've got 2027, my acquisition cost is 120,000. My depreciation expense, year one, is 30,000, meaning my accumulated depreciation first year of the asset in 2027. So this is just going to be what I took during the current year. My net book value is going to be my acquisition cost minus my accumulated depreciation. Right? My net book value is going to be 90,000. When I'm doing double declining balance, I have to be very careful because I'm not including salvage value in my formula. So over here, my salvage value is at 20,000. Salvage value over here is 20,000. And so what my rule is over here, if the net book value is greater than D, which is the salvage value, keep depreciating. If D is less than C, if C is less than D, we will have to manually determine depreciation. Okay, so over here, we're going to keep depreciating as 90,000 is greater than 20,000. Okay, that's for 2027. Let's go to 2028. Over here for 2028. So over here, my acquisition cost is still going to be 120,000. My accumulated depreciation is 30,000. My estimated useful life is 4. Multiply that by 2. So this is going to be over here. This is 120,000 minus 30,000. So this is going to give me over here. This is going to give me 90,000 divided by 4 times 2, or $45,000. So over here, my acquisition cost is at 120. My depreciation expense for this year is 45,000. My accumulated depreciation is going to be how much? Well, over here, for my accumulated depreciation in 2027 and 2028, 2027, I had 30,000. In 2028, I'm taking the current year depreciation plus what I had before. So this is now going to be at 75,000. Let's do it like this. Say this is beginning. Okay. So now my net book value over here is at 45,000. My salvage value is at 20,000. So I can keep on depreciating. So the first thing I have to do in this type of question is to ask myself, can I go through and continue to depreciate the asset? Now, what it says to me is it says on 1/1/29, it decided to switch to straight line for the rest of the asset's useful life. Okay, so let's go through and do this. Okay, so the rest of the asset's useful life is how long? Well, boy, this is a nasty question. I'm going to actually rephrase this. Just give me a moment. I'm not going to change it. Let's go ahead and do it. Okay, so how long have I been using the asset for? Right, so over here, well, I've been using the asset, right? So in 2027, I used the asset for 6 months. And let's think about this over here. If it has a 4-year life, right? So asset 4-year life, 12 months per year, 4-year life. This is going to be a total of 48 months. Okay, so over here in 2028, I took 12 months worth of depreciation. So I've taken a total of 18 months. So over here, if I've got 48 months in a year, I've already taken 18 months. So 30 more months of depreciation expense. Okay. So what I'm going to go ahead and do is I'm going to say to myself, okay, if we're saying that the asset is going to last, or basically we're going to switch to straight line for the remainder of the asset, right? What is it that I need to do? Well, what's my depreciable base? So this is going to be my acquisition cost minus the accumulated depreciation, which is going to give me my carrying value or the net book value, right? Minus the salvage value, because I'm now switching to straight line. Remember, straight line is acquisition cost minus salvage value divided by the estimated useful life. So this is going to be my acquisition cost minus the accumulated depreciation or the net book value minus the $20,000 salvage value. Okay, and I'm going to be dividing this by my estimated useful life, which is going to be, well, my remaining estimated useful life is at 30 months. Okay, so over here, by the way, if you're taking my class, I would never give this to you on a test, but we're going to go through and have fun and just finish it up. So this is going to be divided by my estimated useful life, which is going to be 30 months. Okay, so this is going to be my net book value up until the date where I took the depreciation, which is going to be 45,000 minus 20,000 divided by 30. This is going to give me a monthly depreciation rate under straight line. So this is going to be 25,000 divided by 30, or a monthly rate of 833. In 2029, if we think about it, right? So in 2029, I use this for 12 months. So the amount of depreciation that I would be taking in 2029 would be $10,000. So let's go through and compute out the rest of this. Okay, so over here, my accumulated depreciation, how much have I gone through and taken to date? Well, in 2027, I basically took depreciation expense of 30,000. In 2028, I took depreciation expense of 45,000. In 2029, we're taking depreciation expense of 10,000. In 2030, right? So now I subtract out the 12 months from 2029. That means I have remaining 18, so I can still depreciate it. So in 2030, it's going to be the same monthly straight line depreciation rate at 12 months. So this is also going to be at 10,000. For 2031, right, I'm now at the point where I've taken 2029. I took another 12 months during 2030. So this over here is giving me, I have 6 months left. So in 2031, I've got 833 at 6 months. Okay, so this is going to be at $5,000. Okay, so when I go through and do this in terms of the accumulated depreciation, how do I know if I've actually computed the right amount? Well, over here, I've got 30,000, 45, 10, 10, and 5. So I've got 100,000. So if my equipment cost me 120,000 initially, less accumulated depreciation, and this is going to be through 6, 30, 31. If my accumulated depreciation is 100,000, my net book value is 20, which happens to be the salvage value. I'm kind of going to leave this up here because I would never give a question like this, but I think it's actually good to see kind of like these crazy types of questions just to kind of see like how would you go through and solve it. But there's probably a better way to solve it, but I'm going to go ahead and leave this up here for now. So, but it's not, if you're taking my class, this part would not be on your exam unless it's going to be something like an extra credit. So in any event, I want to thank you for being with me here today and going through this journey. And thank you again for watching. If you have any questions, please feel free to leave them below. And I appreciate you liking and subscribing to the channel. Have a great day.